Well, the Infosys numbers that we've been waiting for flashing on your screens. Reema Tendulkar joins us now with the first cut. Reema, the numbers out.
Thanks so much for that. And there is a big margin beat. Margins have expanded by about 150 basis points, close to that on a quarter-on-quarter basis, much higher than street expectation. The street was penciling in about a 40-50 basis points margin expansion, but at 21.5%, this is a good 100 basis points higher than street expectation. So there is a big beat coming through on the company's margin performance. In terms of the rupee revenue, well, it's largely in line with street expectations. The company has clocked in a 6% quarter-on-quarter rupee revenue growth, but due to the margin expansion, the company's, the profitability has gone up by close to about 12.3% on a quarter-on-quarter basis. Okay, this is the big news. FY23 constant currency revenue growth guidance has been raised by 100 basis points at the lower end. The new guidance stands at 15 to 16%. Earlier guidance was 14 to 16%. So they're basically tightening the guidance. At the upper end, it stays the same at 16%, but the lower end of the revenue guidance has been raised by 100 basis points. The new guidance for this year is at 15 to 16%. Two parts. One, this comes in as a big positive surprise, and it should allay street concerns. Everyone was worried about slowing demand due to the volatile macro situation. But after HCL Tech, this is Infosys, the second large IT company, which has gone ahead and raised the revenue guidance. Secondly, the fact that the revenue guidance is now tighter, which means that the company is very confident. Why do you give a large 200 basis points range, right? The earlier range was 14 to 16% because you never know how things play out. You want to leave yourself that buffer. They brought down the range to 100 basis points, which is indicative of the fact of the company's confidence and how sure they are. They don't need to leave that kind of a buffer. Okay, now let me, there is a margin guidance as well. The FY23 EBIT margin guidance has been revised to 21 to 22% versus 21 to 23%. Okay, so the margin guidance earlier was 21 to 23%. Now they're saying it will be 21 to 22%. It should not come as a surprise because last quarter, after Infy's margins missed expectations, Salil Parekh very clearly said that for the full year, our margins will be at the lower end of our range of 21 to 23%, which means street expectations were anyway close to 21.5%. So the company has tightened the margin band. So this the upper end has been brought down, but I don't think it should cause any nervousness in the street. This is exactly what we saw in the case of HCL Tech. Both HCL Tech and Infy have pretty much raised the revenue guidance, at least at the lower end, and they've tightened the margin guidance. So that is a positive. Okay, there's one more important internal that we would like to talk about, and that's the buyback. The company's buyback size is 9,300 crores. At a price of 1850 rupees per share. 9,300 crores at a price of 1850 rupees per share. The stock closed at 1490, which means we are looking at an upside of nearly 30%. That's a 30% premium to where the stock closed. This will be an open market buyback. Maybe over here, the street is a bit disappointed because a lot of analysts and market men that I spoke to said that maybe this time, Infosys could do a higher buyback. Street expectations, I think IFL was at close to about 10,000, 11,000 crore rupees. So the buyback amount at 9,300 crore, maybe just a tad bit lower than market expectations, but it makes up by the premium, a 30% premium. 1850 is the maximum buyback price, and that's a good 30% premium to where the stock has closed. Let me quickly recap all the numbers that have come through from Infosys, and then we'll invite our experts to give their take on the numbers. Infosys Q1 revenues in line with expectations, slightly lower actually. It's come in at 4% versus expectations of 4.5%, but there is a big margin beat. Margins have expanded by 140 basis points on a quarter-on-quarter basis, driving a 12.5% increase in the profitability. So in Q2, there is a margin beat. The revenue guidance has effectively been upgraded. The company is now expecting revenues for FY23 to be in a range of 15 to 16% and margins to be between 21 to 22%. Buyback has been announced, an open market buyback of size 9,300 crore rupees at a maximum buyback price of 1850, which implies about a 30% premium to where the stock is closed. Sandip Agarwal, the executive director at Nuvoma, now joins us on the show now. Sandip, Thank you very much for joining in. Your first take from Infosys, what would be the top 3 takeaways and what is going to surprise the street?
No, I think, this is a good move of, narrowing down the revenue guidance and also the margin guidance to be more realistic. Because if they would have kept the 14 to 16 range of guidance, then it would have implied a lot of uncertainty and unnecessary confusion of, upcoming. So I think they have removed relation by narrowing both the revenue growth and guidance. Because to see here is that, this is exactly what we also discussed in our preview, and we are speaking in 2 days back. So this is a quarter we will see rise in numbers on the positive side for most of the companies. But a cautious because see, no one wants to take any right because of the uncertainties. I would say one thing that 2-3 quarters you will see commentary will be cautious. Actual deliveries will be very strong. After that, the commentary also becoming optimistic. I think right now is the time where you should buy IT stock.
Sandip, sorry to interrupt you, but we've got you on a very scratchy line, so it's difficult to understand what you're saying. We'll reconnect with you. In the meanwhile, let me call on Moshe Katri, Managing Director at Wedbush Securities, on the show now. Moshe, yesterday the 2 numbers that we got, created a lot of flux, right? You don't know if things are bad, as Wipro's numbers seem to be projecting, or things are good, as HCL Tech was indicating. Now we've got Infosys numbers. What have you made of it? What stands out for you? Where was the surprise?
Yeah, better than expected results. That's number 1, or better than feared results. That's probably a better way of putting it. Margins better than expected. Mixed on the revenue numbers. I guess we're yet to kind of.
Go ahead. Seems like Moshe is getting our audio with a bit of a lag. So we'll try and fix that as well. In the meanwhile, we've reconnected with Sandip. Sandip, go ahead. You were making your point about Infy's numbers. Okay, a little bit of a technical glitch. Let me just run you through some more details that are coming through. So Infosys large deal wins are looking good. It currently stands at $2.7 billion. This is higher on a quarter-on-quarter basis. So that's point number 1. The digital revenue growth. You remember, Infosys, unlike TCS, classifies their business in terms of digital as well as non-digital. So the digital constant currency revenue growth on a year-on-year basis has gone up by 31%. This is significantly higher than the overall revenue growth. That's of 18% on a year-on-year basis. So the rest of the business, which some people would call legacy, has clearly slowed down quite significantly. In terms of verticals, financials has done okay. It's about 11.5% year-on-year revenue growth, but it's lower than what the company's average is. So we would like some clarity, because even TCS's BFSI growth was on the lower side. BFSI called out insurance as a vertical where they'd seen growth moderating. But in the case of Infosys, we'll find out why the growth in the current quarter is lower than the company average. High-tech has also seen growth moderating now to high single digits. But many of the high-tech clients globally have also seen a lot of furloughs as well as issues. So I guess that explains. The street was worried about the outlook from the high-tech clients. We have Moshe Katri with us. Moshe?
Yeah.
Yes,
so good to be back.
You were telling us how the numbers are better than feared, what the markets were fearing.
Yeah. So, better than feared numbers, better than feared margins specifically. And I think we've seen that from some of their peers, that they did a bit better on margins this quarter, given the fact that maybe you have some relief on the cost side. And then finally, obviously, they raised guidance for the year. So these are kind of the 3 big takeaways. And as you said, I think at this point, the demand looks decent. The question is, where are we going to be a couple of quarters from now?
As I said, the deal wins are actually looking good at $2.7 billion in the current quarter. It's much higher than last quarter, which was about $1.7 billion. In Q1, the street was disappointed that the deal wins have dropped off But this quarter, the company is clearly made up, so deal wins is a big positive. There is live footage of the Infosys press conference. It's in person. My colleague Ritu Singh is also there. On your screen, you can see Salil Parekh, who's the CEO, MD. You've got Nilanjan Roy, who is the CFO of the company. So we'll be cutting across to it. Just some more internals. I'm trying to find out what the attrition number is for the current quarter. Attrition has come in at 27.1%, which means attrition has declined on a quarter-on-quarter basis. Last quarter, attrition was at 28.4%. So attrition has come down, so that's a positive. Another number that we are looking at is trying to gauge what the hiring is. I can't calculate, but it looks like the company would have added about 10,000 people to its headcount, this time around, which is a pretty healthy run rate. This would be the average over the last 4 quarters or so. So unlike TCS as well as Wipro, where the hiring numbers were a bit muted, in the case of Infosys, the hiring number appears to be fairly strong. Let me try and tell you what Salil Parekh has to say in his press release. Strong large deal wins and steady all-round growth in Q2 reflect the deep relevance and differentiation of our digital and cloud solutions for clients as they navigate business transformation. While concerns around economic outlook persist, our demand pipeline is strong as clients remain confident in our ability to deliver the value they seek, both on growth and the efficiency of their business. This is reflected in our revised revenue guidance of 15 to 16% for the full year. Do we have Sandip with us? Sandip, go ahead. Tell us your take.
No, I was just saying that, this is the exactly thing which we were forecasting that, this is the quarter where your revenue growth and margin numbers will be positively surprising, but, the commentary will be cautious. Fortunately for us, the commentary is not as cautious as we have anticipated. But next 2-3 quarters, because of furloughs and macro uncertainties, probably you will be in a similar environment where actual results will be better because of the very strong order book in the past, but the commentary will remain cautious. But I think this is, a very good time to start accumulating the stocks because you will have a very strong FY24 in mind.
Thank you for joining in.